All right, I think it's good time to start right now. We have Nitin also with us right now. So thank you everyone. Thank you for joining today's session on all about exchange traded fund. So we have seen tax, mutual funds, investments, and all in the past. And this time we are going niche with ETF. So ETF works more like mutual funds, but with a twist. And we'll discuss more about this in the session. Before we start, wanted to introduce Nova as well. Nova is an employee wellness platform with our core focus centered around health insurance. We also help organizations improve employee well-being through a variety of wellness programs such as daily fitness, mental health counseling, and more. Today we have Mr. Nitin Mathur with us. Nitin is CEO and founder of Tavaga. He has worked as a research analyst for the past decade with the investment banks like Jefferies, Society General, Edelweiss, and Lehman Brothers. Before that, he has handled different financial products and process like transaction banking, securitization, and credit cards for ICICI Bank. He has regularly featured on TVs and print media, so he's pretty famous. So if you have any questions during the session, please feel to drop them in the chat box and we'll take them towards the end. And over to you, Nitin.
Aisha, thanks for that introduction. I hope I'm audible.
Yes, you're audible.
Great. So good to see everyone here, on an evening just ahead of the festive season, and I wasn't expecting such a huge turnaround. I thought ETFs are boring. Yeah, who will join this, in the middle of the week to hear about it? But no, great. Good to see everyone around, and hopefully, next 45 minutes or 50 minutes, we can have a very interactive session in terms of, discussing what these financial instruments are and, how to go about in your investing journey and so on. So before we start, a quick introduction. As Aisha mentioned, I'm a research analyst by training. Did that for 15 years for investment banks, then jumped full-time onto Tavaga. We are SEBI registered investment advisor. We have 3 products. We do flagship robo advisory, we do customized advisory, and we advise small, medium enterprises on their treasury services as well. So that's pretty much about me and Tavaga. What we are going to discuss today, and there are a couple of presentations, and in the interest of time, I'm going to run a little fast. But if you think the speed is a little too fast or a little too slow, please give me a shout on the chat, and we can just modify our sort of speed accordingly. I've got a couple of my team members on the call as well. Kunal and Shubham, they can take your questions as well. So please don't wait, for the end of the session where we'll take some questions. But if you have any questions in the meantime, just keep shooting it out, and Kunal and Shubham can assist you straight away, with your queries, so that the flow doesn't sort of interrupt, So that's pretty much. And I've got like 2 quick presentations, so let me just pull through that, and with that we can actually just start discussing about what we are here for, which is something which is very close to our heart: exchange traded funds. Now, before we start, my first question is, how many of you have heard about exchange traded funds? So please keep it flowing in the chat window about what's been your experience like on the exchange traded funds, and if you have like any sort of previous experience about investing and everything on that. And Aisha, maybe we can open the poll at this occasion so that we know about how things are. And please do participate in this poll, because we're just trying to gauge, what's been your investing experience and how do you invest currently. Just simple sort of, thing while we keep running the sort of a presentation here. So what are exchange traded funds? And it's just like, something like a mutual fund. It tracks the benchmark indices. It's pretty automated. These are the things that one should always remember, that how these instruments are constituted by any of the fund houses. These are run by mutual fund themselves. I mean, they are no you need to have proper licenses, to run about it as well. And these are some benefits, like they give the benefits of good diversification. They can be traded during the day, and those are mostly the benefits which run in the format of exchange traded funds. Now, just a broader sort of thought process around how these things are shaping up. So just the things to remember are simple. It can be bought and sold or just like a stock. So that's one of the biggest advantage of ETFs. You have ability to put limit orders. So those of you who invest already, you will know it has a minimum trading lot, which is just 1 unit. And this is where the real benefits start flowing, because if you start taking market exposure, it will become quite high in terms of entry point and exit point. So you can literally start by 10-15 rupees of ETS. Some of the lowest are priced that low that you can sort of start running it, and you can buy and sell these instruments real time. That's one of the main advantages of exchange traded funds as well. Unlike in mutual funds where you get the day end NAV, it actually does get you the real time NAV, in your portfolio. It's delivered directly into your demat account. For those of you who are familiar with demat account, these are the accounts that we open with brokers. And this is something that we own. The custodians are CDSL and NSDL like places, and it is like the lowest expense ratios possible in the investing universe. So why what happens effectively with the exchange traded funds? The things that to understand is that it reduces risk significantly. Now it eliminates unsystematic risks. So what are unsystematic risks? These are essentially risks which are very unique to any company or an industry. So ETFs are very broad, diversified investment. So you are not like really vulnerable, to a particular stock action. Some stocks might go up, go down, but it doesn't sort of limit you to that. You take a very broad sort of risk in the market around that. It eliminates the risk of stock picking, because you're taking a broad exposure on a market or a theme. Let's say there are various types of exchange traded funds, and we'll come to that in the coming slides and everything. You can have exposure to market, you can have exposure to sectors, so this is the way in terms of how these things play out. It helps you in asset allocation. Now, asset allocation is one thing which is not very highly discussed when we sort of discuss about personal finance and issues around it. But what we mean by asset allocation is essentially allocation going into various asset classes, which is equities, fixed income, gold, international equities, and whichever way you think about your assets can be diversified. For most people, asset allocation normally means buying various forms of mutual fund schemes, but underlying risk for those is always a market. So when we're talking about assets allocation specifically for the sake of this presentation and going forward, always keep in mind that equities are as important in your portfolio as gold exposure is. And then of course benefit from expert opinion. So there are a large number of market participants under which you sort of get an expert opinion, and there's a fairly high sort of price discovery which happened, and that is like one of the main advantages as well of ETFs. I'll skip this slide, but really for those of you who are familiar with exchange traded funds, stocks, mutual funds, the main advantages and disadvantages in various avatar play like this, that you have real-time trading going into ETFs and stocks, which is not the case with mutual funds. You have ability to put limit orders, which is the advantage in ETFs and stocks, but not with mutual funds. It can be purchased with online brokers like mutual funds and stocks. Arbitrage is possible, with between cash and futures market for those of you who do advanced trading. So that's another advantage which is not there in mutual funds. Diversification is possible with a single unit. That's the biggest advantage of any ETFs or mutual fund unit as well, which is not the case with stocks. I mean, in last 2.5 years, we've seen people sitting at home. We took a lot of people take risk in individual stocks, and this is where they actually got to really, sort of distracted and maybe, deviated from their core portfolio allocation sort of a goal as well. But this is one risk which we really avoid, unless you are an expert yourself in stock picking. We really advise people to stay away from single stock exposures. Returns at par with market index, which is the case with ETFs and mutual funds. Intraday trading is possible, which is only possible with stocks and ETFs, and there's no exit load, which is the case sometimes with mutual funds, not always, but sometimes, that's the case with mutual funds. So those are really the benefits of ETFs, under which we sort of have for ETFs. Now there are various types of ETFs, so three types of ETFs that we would like to flag your attention is mostly around equity ETFs, which is where the underlying is equity funds. It tracks the benchmark index. It could be Nifty 50, it could be thematic ETF, it could be like sort of tracking the international tech stocks, like we have Nasdaq ETFs. There are a couple of fund houses who do that as well. So these are the benefits of equity ETFs, where the expense ratios are low. It's actually very low. Now on that occasion, I'd just like to ask the forum, is anybody aware about how low the expense ratios are in ETFs? So please keep writing your comments in the chat, and I'd love to see how many of you are aware about, how low the expense ratios are. And it's very transparent because there's no fund manager discretion involved. Hello? Yeah, sorry, can everyone put themselves on mute? Yeah, that's great. So those are the benefits of equity ETFs, where they're getting the real-time pricing and everything as well. There's gold ETF as well. I mean, again, a very good instrument, very much tracking the benchmark physical gold prices in India. It's a very good, efficient way to get exposure to gold. Now, one of the main reasons we've heard from people is that, gold is a different asset class where, we believe in jewelry, but we don't believe in gold. But again, from a portfolio allocation perspective, it gives stability to your portfolio. It gives really good returns as well at times. And when times of hyperinflation, some of these investments, really work out well, and it's a necessary must-have in your portfolio. And gold ETFs is one of the best ways, to actually take exposure, because you get transparent pricing, there's no storage or security concern, and you're dealing directly with very liquid instruments like ETFs and everything. It's placed in your demat account. Similarly, there are money market instruments, where there are ETFs, which are worth considering, as and when you sort of get a chance towards that. So this is pretty much about, what these instruments are in terms of, the benchmark instruments and everything. I'll probably end this presentation and I'll pick up an interesting sort of exercise, where I would probably, try to construct a portfolio by virtue of exchange traded funds. Now, what happens really is that while you have some of these, units in your portfolios, really what works is what is the right portfolio and how can exchange traded funds help you construct that right portfolio. So what happens is like a typical, problem that we face is there are more than like maybe 1,000 or 2,000 mutual fund schemes. And anybody who says that in mutual funds we invest karna chahiye, okay, that's a great suggestion. But how do you think about investing in any of these mutual funds when you're picking one scheme, which is like 1,000 and 2,000 mutual funds and so on? Now, experts will get away with the advice, throwing away, saying, yeah, do your own research. But then the question is, how do you do your research, when there are 1,000, 2,000, schemes available, which one is the right one for you? And really, it's like a moonshot, it's like it's very ambitious that you'll be able to pick up the best sort of mutual fund scheme, which will perform best in next year, 3 years or whatever. There are people who lose money as well while investing into some of these mutual fund schemes because the fund manager is changing jobs or something, other things happening. So how do you like understand the risk around these investments, and how do you pick up the best performing instrument? And the biggest question here worth considering is it really worth investing or worth picking up the best performing mutual fund? And let me just explain you a little bit more. Now, what happens normally is that what has become like normal these days is scouting for investment ideas on social media. Like people, look at Facebook. There are thousands of Facebook, Telegram groups, where this advice is sort of distributed. And this anybody who's on social media, and I believe most of the people are on sort of social media, they actually fall for these social media tips about the best stock picks, best Diwali picks, best Muhurt trading picks, and so on. Only silver lining is some of the new age digital sort of forums which are more compliant with regulations, but mostly social media is full of noise and mostly unregulated noise. So that's the biggest problem which happens. And typically the dilemma is to how do you put about picking up the best investment portfolio so that your time isn't spent tracking your investments, but you can enjoy while the money works for you. So that's the biggest sort of challenge or anything that we try to sort of figure out. Now, time to focus here, right? Because we are like shifting gears suddenly here. But idea is that when you're thinking about portfolio allocation, so we're going to take a use case here, and This is a time frame which starts at January 2018 and ends in 3 years exactly from that. Random time forums, chose for the sake of this exercise, for educational purposes mostly, where I want to like make a point with everybody that how to probably start constructing some of these asset classes and think about everything. So here, what we are taking is that Lazy Panda is our investor. Good thing about Lazy Panda is really lazy, and Lazy Panda doesn't believe in doing his or her own research. And Lazy Panda actually ends up investing 100 rupees into Nifty 50 ETF and gold ETF. So that's the way Lazy Panda thinks about asset allocation. He didn't bother to do his or her own research, and then thought that probably that's the best way to think about equity allocation at the start of January 2018. Let's say 50% allocation going into Nifty 50 ETF and 50% into gold ETF. Now let's look what happens 3 years from that time, right? So what we're looking at when you're going to sort of allocation, when we're looking at the end of December 2020, because gold was a better performing asset class in this 3 years time, the asset allocation has changed completely. So 57% sits in gold now, while only 43% sits in equity exposure. Now, there's nothing wrong or right in that. Only wrong thing is that there's a risk reward matrix. There's a risk reward objectives that were set earlier at the start of the journey. That okay, 50% will be in equities, 50% will be in gold, and you already deviated significantly from that mandate. Where you would have thought about, your asset allocation really. And what happened in March 2020 when we saw sharp sell-off, basically, the portfolio would have still be down by 8 odd percent. So you're not immune to sort of, portfolio drawdowns. So you have a risk, which is sitting there in your books in terms of equity exposure. The asset allocation is probably deviated, from what you thought initially. No, nothing wrong or right in it. To be honest, it's absolutely fine the way people think about, investing. There are various theories which are endorsed on social media, which is like do your own research. There are various theories endorsed on social media, which is like buy right, sit tight. And whichever philosophy you follow, this is how it shapes up right now. So let's move to the next level. Now, what happens if the target asset allocation was maintained with monthly rebalancing? So what it would do is, in this exercise, what we have done is, we have sold the better performing asset class, and we have bought the less sort of, performing asset class at the end of every month. So this will just maintain what we're doing is essentially we are maintaining the 50-50 equity and gold asset allocation simultaneously, 50-50 and gold sort of allocation. So the returns that is generated with this monthly rebalancing is superior to basically where you are not doing any rebalancing. That's one of the observations. Now, issue with some of this empirical data is that you can always argue about the time horizons, whether that's the right time and wrong time, the way we look at things, and it could have been different in different time frames. But for the sake of this exercise, let's stick to this what we're seeing. And the second learning is that really, despite such a movement, the portfolios were actually not immune to drawdowns. So what would have happened is in March 2020, the portfolio would have been down by 10 odd percent. And so what you're doing is you are like aggressively buying and selling, or you are chasing returns or you're chasing a target asset allocation, which you want to maintain in your portfolio. But that doesn't mean that your portfolio was immune to drawdowns. In a sell-off scenario, what we saw like 2.5 years back, your sort of portfolio would have still been down. And think about a scenario where you are always, let's say, if you're sitting in March 2020 and you have to pay for your children's fees, school fees in June 2020, or if you have to pay for any other commitment in June, July 2020, your portfolio would have still been down. So this strategy probably again would not have worked really, in terms of your asset allocation, your rebalancing, and your financial goals effectively, which is what will keep your mental and financial health intact. So let's recap. Two takeaways that I want you guys to take through this exercise is that rebalancing is only ensuring your target asset allocation. Here in this case, what we have seen, and despite rebalancing, portfolio isn't immune to drawdowns. That's one of the main learnings that I want to really pass on. That you are rebalancing, you are like maybe buying or selling your mutual fund schemes, you're buying and selling various instruments, stocks, this and that, and despite that, I mean, if market conditions are bad, your portfolio is not immune to drawdowns, but at a very high risk that it will impact your financial goals. And that's one of the key learnings that we want to sort of, go ahead as well, that you have to like really keep in mind that financial goals are as important as anything else in this world, and the way to do about it. So the real question, that we sort of ponder now, what is the right way to think about financial goals and overall portfolio allocation? Now, if anybody has any answers to it, I'll be keen to know on the chat, please keep it flowing, because the next two, three slides, I'm going to come on that in the way to think about some of these financial goals, portfolio allocation. But if anybody has any answers, I'm very keen to know, of how do you guys currently think about your financial goals and overall portfolio allocation, and then, what we are going to suggest is what is the right way, or what could be one of the approaches to think about, various ways of approaching the financial goals. One approach is something called glide path investing approach. Now, this concept was made popular by Vanguard Mutual Fund in the US, when they launched something like a target date fund, glide paths. So what it does is essentially it's a time varying asset allocation strategy, and it just helps make a need, sort of make the investor achieve a financial goal. That's the way it thinks about it. Or in simpler terms, the right chart that you see here, this is how it works for us here, is that you decline your allocation to risk when you're approaching closer to goals. So it's an indicative sort of an asset allocation. What we're indicating here is that when, let's say, if you're 7 years away from your financial goals, you have a big appetite for taking risks, essentially. But as you're moving closer to your goals, you have to think more and more about principal protection and not take market risks. Because a lot of time, we get asked this question that, acha yaar, 6 months ke baad paisa chahiye, so can we like invest into stock markets and they will give 15% or something return, while FDs will give 4% and this and that. But it's not the way things work, unfortunately. The right way to think about it is if your financial goals are something very close to you, which is like less than 1 year or 1 to 2 years, you can't really punt with that money and say that, okay, let it earn a sort of, interest of equity markets, which are long-term 15%, 14%, whatever, So the right way is, as you're moving closer to your personal goals, this is where you have to become more conservative. As you are away from your financial goals, this is where you can play more aggressive, have more equity sort of an exposure, and lesser of, sort of gold or, debt ETF sort of an exposure. And glide path investing works across like various factors. It also helps massively into sort of your diversification. And I'm going to come in the next slide, of how you can reduce risk as well. But really, the message that I want you guys to take is that there's no one size which fits all. Your separating financial goals have to become a necessary part of your overall portfolio. You cannot mix and match. There are financial goals which could be buying a house, buying guitar, which could be going on holidays, which could be, children's school fees or something, buying gadgets, anything that you can think of. Start thinking of those as different portfolios, because every goal is different and every portfolio is different. It's and every individual is different. That's the way you have to think about it. Just because Gupta ji bought ITC ka stock shares doesn't mean that it's the right stock for you. That's the thought process that we are building up here. And then, of course, just a technical side of it, how we look at the risk reduction in the overall portfolios and everything. This is where, some of the simple maths work out, and we've done a lot of science behind it, so there's a lot of things which exist in our literature on Tavaga.com, and, this Tavagapedia, where we educate users as well about how to think about various financial jargons or anything. But the biggest thing which happens is when you diversify by virtue of ETFs, what helps you is reduce the risk tremendously. And this is one thing which is very, very important when you're thinking about sort of, investments. A right mix of, various instruments, and you can reduce your risk by more than half. And this doesn't necessarily mean that you're compromising on returns as well, by the way. Returns can be, equally good as markets, or even better, by virtue of diversifications. And again, depending on the period that you pick and choose, you can actually look at some of the data points as well. But this is essentially, possible. If you create your portfolio by ETFs, you can reduce your risk by more than half, and you can achieve similar or better returns in the market itself. You can diversify. You can actually have a really good entry and exit points, low sort of expense ratios going, and these are the factors which work out absolutely in your favor. So on that note, I'm probably going to stop the presentation and take questions if there are any.
I have a question. This is Venkat.
Yeah, Venkat, hi.
Hi. When I trade ETFs, I see some error in the pricing. I know that when I observe the INAV and the ETF price, the ETF price is derived based on the demand and supply. So how to overcome this problem?
Sure. I'll ask my colleague Kunal to take this question. Kunal?
Hello, hi. Am I audible?
Yeah.
It's Venkateshwara, right?
Yeah.
Hello, hi. So it's a good question. I see a similar question in the chat box as well. So the thing is, almost every asset management company is going to have a little tracking error, and I'll send you the data as well in this chat box after I speak. Every AMC is going to have a little tracking error in one or the other scheme. So ABC AMC might have a tracking error in, say, a Nifty 50 ETF, which is higher than its peer XYZ mutual fund. But let's say XYZ mutual fund might have a lower tracking error in some other scheme. So almost all the AMCs are going to have a little tracking error in almost every scheme. So and that's because sometimes the market makers which AMCs have to ensure that there is liquidity in the market are not able to probably live up to the demand and supply requirements, or so there are multiple things due to which there's a small difference in INAV. But that said, that difference is very minute, and unless you are trading for short term or intraday or something like that, it is not going to affect you that much. Rather, as an investor, it's probably not going to affect you at all in the long run, to be honest, unless and until you're not buying a particular scheme which is having a very high tracking error. And I can tell you where you can see the tracking error as well on the AMFI website, which is a mutual fund self-regulated website. So I can share you that link as well, and an Excel sheet as well. So you also get an idea as to almost every AMC will have a tracking error in one or the other schemes, which is higher than their peers as well. So that's one more thing which I wanted to tell you is that you told about INAV. So right now you must be seeing that in few international ETFs, the INAV must be very high. And in few international ETFs, the ETF price must be very low, or there must be some greater mismatch. That is because the regulation which has come right now by RBI and SEBI, and that is the main reason. Otherwise, you should not probably worry much about the difference between the INAV and ETF if you're an investor in the long run, and if the difference is quite low.
Okay, thank you.
Did I answer as per your expectations, or?
Yeah, great, thanks.
I'll share the this thing as well. I'll share an Excel sheet which I've taken from AMFI's website, so it's authentic.
Hi, this is Surajit here. I have a question.
Yes, Surajit, hi.
Hi. So let's say I want to invest in index fund or sort of some kind of fund, and like what will be the best bet to us? Like we have like several options in terms of index funds, and there are mutual funds, there are ETFs. So what will be the best suggestion? Like should I invest through mutual funds, or should I invest through ETFs? And what is the like expense ratio or comparison here? Like this
sure.
Kind of
are you like already an investor? How do you?
Yeah.
Okay, great. So idea is if you're already an investor, the way to think about some of these questions is what is the expense ratio like, when you're investing directly in a mutual fund versus an ETFs, So I asked this question, but you'll be surprised about, how low expense ratios are in ETFs. It's as low as 0.1% as well, for some Nifty ETFs, by those mutual fund houses. Are you getting compromised on returns? Answer is no, because the latest Standard and Poor return report says that in last 3 years 82% of the large cap mutual funds managers actually underperform the benchmark indices. So you're actually saving that 2% every year, and that's compounding in your portfolio over a longer period of time. If you start investing into exchange traded funds, that's another big benefit of ETFs as well. Which ETFs you should invest? Answer is I don't know. And why I don't know is because it's very unique to your own financial goals. It's very unique to your own personal finance planning and everything, where the right way approach to is, to maybe consult an advisor of what your financial goals are, and accordingly that then come to a conclusion that which ETF can be good for you and which ETF can be bad for you. Now, let me give an example on that. There could be some commodity ETFs, or there could be Hang Seng ETF, which attracts Chinese markets. Is it going to be the best performing ETF, let's say next 1 or 3 years time? Answer is I don't know. I'm as clueless as anybody else, that you can think of. But in portfolio, let's say if I have this in my portfolio, what would this ETF do to the risk which will come in my portfolio? And is this the best instrument that I should actually, keep it in my portfolio? And this is where, we need to be sort of, we need to be aware of, whether it's the right instrument for you or not. Now, commodity ETF might exactly be the right instrument for Venkat, who just asked the previous question, but it might absolutely be a disaster for you, So that's where personalization really matters, that what is right for one person might or might not be right for another person. So there's nothing like one size fits all approach that we firmly believe in. It's very much dependent on your financial goals. It's very much dependent on your personal finance situation and your risk appetite as well. How much risk are you willing to take?
Okay, so like what I said, I know what is Nifty giving past 3 or 4 years return in terms of, and I know the cost a mutual fund house can get from me, and where is the ETF stand in this scenario? Should I move all my investment to ETFs nowadays from a mutual fund? If there are let's say two funds, one is ETF, one is mutual fund, and two funds are taking similar expense ratio, so where should I invest?
Sure. I mean, any day ETFs, so answer to that is ETF any day. And as I said, right, there are three things in favor of ETFs. One is lower expense ratios, which can be, really in your direct fund, it could be 1.8% versus, ETF is 0.1%, so that you get that cost benefit directly flowing into your own sort of channel, so that's one of the big factors in your favor. And that gets compounded over a period of time as well. Let's say if you keep investing for 25 years, so this 1.6%, actually adds in your portfolio returns. That's the biggest thing in your favor, there. Second is around the performance bit that I mentioned, right? The Standard and Poor return report, which did some analysis about mutual funds performance and ETF performance, actually said that 82% of large cap fund managers actually underperform the benchmark indices. And this is the real, moat is that for any personal finance, if you take a Nifty 50 sort of an exposure, really you want to have something going on which really helps you in terms of, performing at least market returns, if not better. And in that case, totally, you're dependent on ETFs as a portfolio. Where mutual funds, actually become a better bet is, let's say, if you want to take exposure into small caps. And this is where the fund manager, can apply his or her discretion, and you can, probably expect to achieve higher returns. Again, that might be subjective, that might not be the best bet for you in your personal finance pedigree, while it might be a great sort of addition for Venkat in his portfolio, so that's the way to think about some of these investments. But if you're comparing like to like between a large cap mutual fund and ETF, I would any day go for ETF.
Sujit, I hope you are answered on that. Thank you, Nitin, for sharing your wise knowledge here. I'm just going to drop a little thing on your chat where you can get Tavaga's of 50% off discount code for the annual subscription. So you can check out Tavaga. So as mentioned, Tavaga is investment advisory and we're on the learning side of it. I think Nitin can give more context about Tavaga here rather than me.
Sure. I mean,
You would like to-
thanks. I think it's Diwali time, so and we are very generous in festive mode. So please visit the website tavaga.com, and there's a subscription sort of discount code as well. So please save that. In we are very thankful to Noah to host this session and bring everybody on one platform to learn more about investing via ETFs. So use this discount code. It's valid for on our advisory services, which is 600 rupees per customer per annum, and you get a discount if you go through Noah 50 Noah 50 as a coupon code to take that benefit. If you have any questions, drop us a mail on support@tavaga.com, and one of our advisors will pick up, and maybe we'll be able to respond to you better on a personalized sort of a manner. So that's one of the ways to probably just get your portfolio checkup. If you want your portfolio checkup, also just shoot it out there on support@tavaga.com. We can review the portfolio and then probably have a mature conversation, and a confidential one-on-one conversation as well, on this forum, on this topic specifically.
Yeah, great. Thank you. I think we can continue with the question. There are more questions that is coming in.
Yeah,
so I'll continue with the ones from Bipin. So
Yeah.
Bipin was asking which ETFs are most accurate at tracking, and also different ETFs have different expense ratio. So should we choose the ETF that has the best track of market, or should we go with the least expense ratio? So I think the correct framing would be which filter should we apply when we are selecting a ETF?
Yeah, so I'll again invite Kunal to take this question, please.
Okay. Hi, Vipin. I just typed the answer in the chat box because I thought you asked it like very early and we couldn't answer you. So, like I've said, all the AMCs will. I replied to Mr. Venkat as well. All the AMCs will have tracking error in almost all of their schemes. So, say, like I said, an ABC mutual fund might have a high tracking error for its Nifty 50 ETF, but than XYZ mutual fund. But an XYZ mutual fund might have a lower tracking error in say, for example, a Nifty Bank ETF. So every other scheme will have a higher tracking error in one of the other schemes. That said, tracking error or even expense ratio cannot be a metric or a filter to purchase ETFs. I'll be honest, the best way to buy an ETF is to first ask your SEBI registered investment advisor rather than just filtering out on your own knowledge, because if AMCs increase their expense ratios as well on ETFs as well. So it's not like because ETFs have low expense ratio, they should be filtered on which is the AMC with the lowest expense ratio. So that said, I believe that neither expense ratio nor tracking error can be a metric, like if we consider them solely. Rather, you should have a collective mechanism of expense ratio, liquidity, tracking error, the fund manager, then how like the demand, how the market makers are in a particular situation, how the AMC responds to black swan events. So during COVID-19, I could see that a lot of top AMCs could manage liquidity very well, but many small AMCs couldn't do it. I'm not taking any names over here, but there are a lot of metrics to check as to if you want to filter out which is the best ETF to buy. Only expense ratio and tracking error cannot be the answer. Again, expense ratios will be similar to almost all the schemes in a particular category. So Nifty 50 ETF will like Nifty 50 ETF of say ABC, XYZ or any other scheme will almost have the same expense ratio unless the AMC is doing something really great and they are charging a high expense ratio. So yeah, so I'll recommend you to probably discuss it with your advisor, or probably you can email us or something like that, and we can help you after checking your risk appetite and all the stuff, because answering you directly cannot work help you as well.
I think Kunal, thanks, that helps. I think Vinay, if you can just switch on your camera, because that's an important point that you're asking. If you can just switch on your camera and mic and maybe ask this question.
Yeah, hi. Hi, Nitin.
Hi.
Just give me one moment. Yeah, hi. So yeah, I have been actually meeting a lot of financial planners because I want a financial planner to maintain, I would say, to maintain the amount of money I'm earning, though it is not a lot because I just said maintain the amount of money I'm earning. But yeah, so it's just that, I tried investing in mutual funds and then I realized that it takes a lot of energy to research, and I might not be a right person to think that this is the right mutual fund that I should invest into, because I don't know, I don't have a financial background as such. So I have been looking and I have been meeting with a lot of financial planners, I would say, but I just don't know which one to choose, because all of them are providing like sort of similar um, facilities. Like, they will do a goal, they will note down your goals, they will ask you how much expenses you are making, what are your incomes, expenses. You have to list down all that, you have to tell them the goals, and it is a fee based model. So they will charge you, let's say, around 20 to 30 to 40,000 per year to do that, and after that they will charge you some percentage depending on where you're investing, like stocks or mutual funds.
Yeah.
But yeah, so most of them, the services are the same, but then how do I know like which financial advisor would be the right person? Like, how do I choose that person?
Sure. So first thing, I mean, I'm slightly of different opinion that no amount is small enough to get started, So I don't know why we get defensive, I mean, every money is important, trust me, Even if you're investing like 1,000, 2,000 rupees per month, it might mean a lot for us. I mean, we have some people on our robo advisory, they are investing as low as 800 to 1,200 rupees SIP, and they set up goals for their children's school fees, for which they are diligently, sort of saving every literally every month, despite market conditions and everything, and this is the level of diligence that people actually get into. The lesser you have, I think it's good, in terms of getting the discipline of investments, really early in your career cycle and everything, because as you grow further in your career, you'll earn more and you'll have more choices going on as well. So one way, is like no amount is small enough. It should be literally like income minus investments should be your expenses every month. That's the way one should think about going into any of these fronts. Now, the bigger question that you asked literally is, how to choose a CFP. That now there are chartered financial planners and other ways jargons going on as well. So idea is, I mean, the way I would think about it is. How much am I willing to, sort of invest every month and or every year, let's say, versus what is the fees which will, sort of help me. Is the fees one time? Is the fees recurring fees per annum, paying semi-annually? These are the factors which are obviously, thought after for when you pick any of the advisors and everything. The biggest thing is, is the advisor SEBI registered? Now, one thing that we take a lot of pride is being, SEBI registered investment advisor, RIA, which is the right sort of, approach to think about whenever you're dealing with any of the CFPs or anybody else in the marketplace as well. Now, SEBI did this big exercise a couple of years back. They said that anybody who's distributing mutual fund cannot call themselves advisors as well. So the terminology became very holy in the parlance of SEBI, that if you even if you have like advisor in your company name, you have to get rid of it, and you can't have any trailing commissions and everything going around as well. So the factor I'm making here is, if your advisor is quoting you any fees, I don't know, 25,000, how does, as a percentage of, let's say, your annual investment, what does it work out to be? Does it work out to be 1%, 2%, 3%, 5%? That's one of the ways to think about it. Second is, how much experience would the advisor have? That's another one important factor that will come into picture as well, that what experience is the advisor bringing on board in terms of helping you with various investments. Like the way we work is, we have a team of 5 odd advisors who are fairly qualified, more than a decade experience each, and they sort of contribute to any investment decision which goes, to our sort of customers. And that is one of the factors where we brainstorm, any new product, which comes in the market, it's very unlikely, that it will fly through our platform to our customers. To give you an example, last week I was approached by one of the P2P platforms, and they said, yeah, we provide higher interest rate and this and that. Why don't you recommend this to your customers? And I know that, my set of customers, our set of customers, in their risk profile, the P2P lending and some of these things don't fly and shouldn't fly. or it's a little early for them. They can think about corporate bonds, they can think about fixed deposits, they can think about other areas where they can earn higher interest, but not P2P. The risks are something which even these fintech platforms don't understand. So this is where your advisor has to keep on top of industry trends as well, because last 2 years there were Bitcoin, crypto, and all sort of nonsense coming in as well. Which was, again, we intentionally took a business call to keep away from that totally. And we were very happy when SEBI actually came out with a circular saying that RIAs like Tavaga, cannot advise people on cryptos and cryptos and Bitcoins of the world, essentially. So these are the factors that you have to keep in mind, that how much momentum plays into mind of your advisor, for any decision making or product selection or whatever, as well. And last but not least, anyways, just like you go to a doctor, you get yourself checked. If you're not happy, you change the doctor, right? So that's the only right approach which I can think of, to happen. That unless you try somebody, you'll not know whether that portfolio is working out for us. Now, one of the things which SEBI did to RIA as a community was that we cannot give our advice without charging fees. Now, earlier we were also giving our advice for free, but then we figured out as well that SEBI doesn't want it to run it that way. It has to be a fee-based advisor only, and first we have to charge fees, and then only we can give advice. So that's done in the benefit of the industry overall, I believe. And so unless you try that, you would not know whether this person is the right person to sort of advise you. But I would look at qualifications of the advisor, the product portfolios that he or she is endorsing, the expense ratios for these products as well. So why pay somebody 30,000 when instead of ETF, this person is again advising you on some mutual fund? Why should you pay that when we know statistically that 82% of large cap fund managers are underperforming? So cost savings is the only thing which you can control, in terms of your returns. You cannot control the markets, you cannot control the Russia-Ukraine war, you cannot control, sort of any other factors, which are there, exogenous factors, which come into play. So these are the factors. I don't know, Kunal, you want to add something here where we can, apply some scrutiny on, how to look at the advisor?
I believe the advisor, probably they should not be into the distribution business, as Nitin said. I believe that advisors cannot directly sell mutual fund to the same customers, but some advisors, like, they have a differentiation, like they don't mix up their clients, they have a distribution license as well, and they have an RI license as well. I believe that can be a filter that you can consider it personally, rather than, because I cannot give a definite answer to this, because it's always an opinion as to what is good and what is not. Also, the experience of the RIAs is one area where you can watch out for. You can probably have a good discussion with your RIA before getting on board, because one of the parameters, what I always feel, is that how will your advisor react to short-term issues which go into the stock market? And if he or she is changing his view every time something happens, and especially if you're a fundamental long-term investor, then I feel that probably this is one area where you could always have a good long chat as to what would you do. See, you cannot, of course, you don't have to ask for a particular direct advice, but will your
portfolio check, probably, a portfolio check every now and then, can be sort of a good I'll say an eye opener, in how things are effectively.
And how much?
Sorry.
Yeah, and how many months do you give someone a try to know that whether that person is working or not? Because it also depends on the market, I suppose. So if the market is not performing, then how do I know whether that person has given me the right advice in the first place?
So that's a tricky one. Idea is that it's always some of those things, are very subjective, of how the responses are and how the conditions are. 12 to 18 months can be a fair bet, in my opinion. There's no science attached to it. And it's also about your comfort with the advisors. You think about it, you're planning your financial goals, you're planning for your savings, you're revealing a lot of your personal information to the advisor. So how comfortable are you with him or her, basically, in terms of, the information that you're sharing? If the rationale is fine, if this answer is for not performance is fine, then you can probably continue for longer with underperformance as well, saying that, okay, fine, some of these things have not really worked out as per advice, but because the holistic personal finance and risk allocation side is taken care of. So you might feel comfortable with him or her, running your portfolio as well. But you'll have to give some time, definitely. 12 to 18 months is something that I can think of, that probably to sort of get into a relationship, I would probably give somebody and then, take it from there.
Understood. Okay. Yeah. Thanks a lot, Nitin, and thanks a lot, Kunal, for answering my question.
We also have a free ebook to pass on to you, everybody who's present on the webinar. And, so that's one link which will be circulated at the end of this call, maybe via email by tomorrow or today evening, late evening itself. But there's an ebook on ETFs, which we have prepared. Our team at Tavaga worked very hard to prepare a basic introductory ETF email, so go through that. There will be tons of information on that as well. As I said, like please keep please keep checking your portfolio health. So as much as your mental health is important, your financial health is important, you need to get all these portfolio checked from time and again, as well. So that's another, there's a link, which our team has placed there. So please go through that link as well and book up your free consultation with any of our advisors at Tavaga, and we'd be very happy to help you, with anything that you need in your portfolio side. So Ajit, I think your question is answered by Kunal now. So I think in the interest of time, maybe we can finish this call here. And thanks again, Noah, for organizing this wonderful interactive session. I wish a very warm and happy Diwali to everyone. Please celebrate festival to its full glory, to the justice which it truly deserves. And if there's any doubt, reach out to us at support@tavaga.com. We'll be very happy to help you with anything. Thank you very much. Thanks, Kunal.
Thank you so much, Nitin and Kunal from Tavaga. And this has been amazing. I think most of the questions and most of the people here we had was the ones that was genuinely interested in ETF, and I think they might have gotten some insight about the same. Thank you for joining again. Thank you everyone for joining. I have just dropped a session that is upcoming on the 28th, was our musical session. Every month we have the session as we celebrate the month end. So I hope you join that too. And thank you everyone. Have a great weekend and as well as a great Diwali. Great long week.
Thank you.
Bye. Bye everyone. Bye.
Yeah. Bye. Same to you.
Bye. Thanks.
Bye. Bye everyone.